Uh, okay, good morning. So we are moved to a new office because new classroom because of the conversation. Now we're all set. So today's plan, we're going to finish our additional example on fair value hedge, and we will go over a short example on convertible, not convertible, yes, convertible debt. Just go through that, a little bit of review of what happens after convertible debt is issued. And the third item on today's agenda would be like I said, we'll have a theme for each chapter. We cover this course, we will like kind of have a review of a topic that kind of string things together, string what we need for this chapter and what we learned before. So the review topic for chapter 17 is financing structure. That's today's plan. Let's continue with the example of a fair value hedge. Okay, so this is the example we went over very quickly just to read this. So the company has a fixed rate bonds, and fixed rate bonds, the interest payment doesn't change. However, that's not the company's concern. The company concerns is it does not want the bond fair value to change. You know, so they entered into swap to swap this fixed interest rate payment with a variable interest rate, variable rate payment, and the swap date will coincide with the payment date. So that way, effectively, instead of paying a fixed rate, the company will pay a variable rate. And so that qualifies as a fair value hedge. Now, as I said, this for our purpose, what kind of hedge it is, it's fairly easy to identify. Usually, if you are hedging the variation of the value of an item that's already on the balance sheet, that's fair value hedge. You are hedging about the payment you're going to make or receive in the future, and that's cash flow hedge. And just to quickly summarize, fair value hedge, for hedging item, we use fair value through net income. The rest, you do whatever you have to do. If they have to depart from normal accounting, so be it. All right, you want to make sure the symmetry is restored. For cash flow hedge, you use fair value through other comprehensive income for your hedging item, which is departure from derivative accounting to begin with, right? The purpose that is if you use elective fair value hedging accounting. That's if you choose to use hedging accounting. Otherwise, you don't have to absolutely restore that symmetry. It's better, but that's your choice. Okay, so let's look at this one. So let's first see what happens. Okay, the journal entry is related to that. So on December 31st, they entered into the swap. Okay, swap will require them to pay a variable rate based on the $10 million and receive a fixed rate based on 8%. On June 30th, 2018, the LIBOR rate, that's a variable rate now applicable for this case, is 7.5%. And the fixed rate is still 8%. So what happened is on this date, that the Robi will have to pay the first accounting bank 6-month interest at 7.5%. and receiving 8%
sugar
interest based on $10 million. So this is in Roby's favor. Yes? Yes. So then it makes sense, the fair value swap has a positive value. Later on, 6 months later, the LIBOR rate now is 9%. So that means the Roby will have to pay 6 months interest on $10 million based on 9% rate, and then receiving interest on 10 million at 8% annual rate, right? So that is not to Roby's favor, right? Swap position change. Now it's in its counterpart, which is First Accounting Bank's favor. So this swap would have a negative value, meaning this will be a liability now. Okay. Now, the gain and loss on the bond change accordingly, right? So see, that is a 460 and that's a 660. That's not a typo because the change from 200 positive to 460 negative is 660. Okay, that makes sense. Any question? Okay, so if we're okay with that, let's just go ahead to do the answer. So on December 31st, there is no answer. Because this swap contract is entered without any consideration. So just now they entered in the contract. June 30th, 2018. So that's like
Girls,
so just to show what we said on this. Numbers in here. So on this date, swap receivable. So basically, what Roby received under swap contract, right? It will be I will put in the calculation for this time. I will skip it the next time. So swap requires the first bank to pay in rate at 8%. So it's 8% on $10 million. And we adjust for the fact that this is for a 6-month period. So that means Roby will receive $400,000. Okay, and payable at the LIBOR. So that it also under the swap. Yes. Yes. Is it better? Yeah. Sorry. Thank you. Oh, yes. Oh, someone must be talking. I cannot stop. I cannot hear, but probably they can. That's who is not moving. John Joseph. That's it. Okay, unmute everybody else. I'm the only one talking now. Okay, payable also under swap. So payable under swap. Let's put it that clear, right? So this is what we're talking about. At the LIBOR. So its LIBOR rate is 7.5%. Okay, and you do apply the 7.5%. on 10 million adjust for 6 months. So we're looking at a payment of 375. Okay, so cash settlement. So I think this word is also used in the assignment. So when they say cash settlement, it means net settlement. Okay, so cash settlement would be a net payment to Roby at 25%, at $25,000, right? Okay, so that would be the calculation. Okay. So to journal entry required, again here that there is different way to record it, that as long as after, if you use 1 entry, 2 entry, as long as at the end of it the account balances are correct, you can record it in different ways. Sometimes you break it down, sometimes you combine several entries. So we are at our fourth financial accounting here. So so we should be okay with that. Just like, oh, don't ask me questions like, would it be wrong? Would you deduct marks if I break it up into 2 entries? Of course not. Okay. So here would be debit cash. Actually, let's just do it all together. I will do it first, the interest payment, because in name, Roby is still the bond issuer, right? Roby still pay the interest. So it'll be interest expense, and that'll be $400,000, because this is between Roby and the bondholders. This transaction, this entry records what happens between a Roby as a bond issuer and so that's it. This is between Roby and the bondholders. And the next one is between Roby and the First Bank. Net settlement requires First Bank to pay the difference to Roby, and this payment would reduce the interest expense by the payment. Yes. That's 7.5% on $10 million, 6 months. Okay. So now the net interest expense for Roby for this 6 months is 375. Okay. So the net settlement received from First Accounting Bank reduced interest expense. Make sense? Okay. So that's what we record reflect what we just said, right? Yeah. Okay. And then we have to record. Now we also have a derivative, right? Remember the derivative value increased by 200,000, and this is a fair value hedge. So fair value hedge, we don't adjust the notes payable, bonds payable in this case, but we will have to record the derivative value increase as so a swap, or you can call it a derivative, financial assets and liabilities, whatever you want to call it, that's all fine. Now it has a value of $200,000, and that is a gain. So that will be unrealized gain. And now we want to recognize it, but we do not want to upset our symmetry. So we recognize it in other comprehensive income. So I want to highlight this part, this gain being other comprehensive income, that's working of the hedge accounting. If the company choose not to use hedge accounting, this gain will goes into net income. That is like, in a way it's settled, but it's all the difference in that part. Does that make sense? Yeah, because there is a loss on the bonds, we're not recognizing it. And the whole idea to enter into this swap is to, the loss on the bond and the gain on the swap will be canceled each other out, right? But if I recognize this and not recognize the gain here, but not on the bond, I will have a net gain. And they did not offset in my account. So what's reported under accounting and what's going on in reality do not match, right? So this is, now, that just for fun, I keep saying now you can't recognize it, but am I recognizing it here? What do I mean? Like, you know, you don't recognize the loss on the bond, you should not recognize the gain on the swap. So there is a symmetry, but am I recognizing it here now? Am I being inconsistent? No, I'm not. Why? Exactly. This gain is not going to be in the income statement. There is a symmetry in the income statement, and that's what counts. That makes sense? Yeah, okay, so that's on that. And any questions? Okay, so next, interest date will be similar with the different amount anymore. So just to speed things up, I'm going to copy this and I'm going to, yeah, let's just do that. Okay. So for the December 31st, 2018, the swap receivable is still 400, but the payable under swap under LIBOR is no longer 7.5%, it's 9%. We were told that, right? We were told that in that. And therefore, the payment will be 450,000. So this time, Robi will have to make a payment as a result of being party to this swap contract. Okay, so situation will be different. So first of all, the relationship with the bond holders are still the same. They still have to pay interest to the bondholder at the stated rate, the nominal rate, and then the fact that no, I won't read it. Okay, those are just my explanation. Okay, and now they will settle with the first bank. Okay, so this time they have to make a payment. So they will pay for $50,000. And this payment become an additional expense. This payment becomes additional expense. And so, I think it's move it a little bit so it'll be not one page. So the expense for the 6 month and December 31st, 2018 would be 450,000 because now they actually pay the LIBOR rate, right? So they this pay settlement was the first accounting bank adjust for the change in the LIBOR. And then we have to record the change in the value of the swap, the derivative. Swap is a derivative. So this time the value have changed from asset of $200,000 to a liability of $460,000. So the change from debit of 200 to credit of 460 is 660 credit. And that means unrealized loss is 660. If you want a clear picture, T account is always a good tool to use. You can see what the balance of T accounts after these adjustments. Okay. Make sense? Any questions? Okay, so that's what it is. Now, for the second part was assume that a company follows efforts but decides not to apply hedge accounting. If the company decides not to apply hedge accounting, now let's redo all these. That's a lot of redo, but actually it's only one account that will be treated differently, right? So the swap being derivative, you'll be treated as normal derivative. Okay, what is the normal treatment of derivatives? Fair value through net income. Any gains and losses from fair value changes will on derivative will be recognized as net income, go straight to the income statement. Okay, and that will. So everything else is the same. So I would just copy the whole thing. There's no entry on the date the swap is entered. Okay, there's no entry on that date. And so all the calculations the same, and all the journal entries same, except one. The only part that's different is this. So I will highlight it in a different color. Let's see, electric blue. Okay. Okay, everything else is the same. So this will be in the net income. And there's no symmetry in this case because they did not, they just elected to treat this derivative as normal derivative, did not elect to use hedge accounting. And then same thing for the next part. That's okay. Same for the next part. And everything else is the same except where we deviated from normal accounting for derivatives before. Now we go back to that fair value and net income treatment. Okay. Okay. Any questions about this? Hearing none, we'll move on to a additional example of convertible bond. And I will put that on the bright space after the class. We'll just leave it at that. Okay. So I want to run through the example that covers the issuance of convertible bonds. Convertible bonds is an example of compound hybrid financial instrument. It has more than one component. And you have a bond, which is debt instrument, but they also have a conversion feature, which is considered equity. And so there are some options under ASPE, but the residual method, incremental method is used for under IFRS. And basically you measure debt first, and then you measure whatever left residual is the equity. So this will rely on us knowing how to measure debt, And I know that is a difficult part, kind of to absorb, so I want to go a little over. So this question is given in such a way that allow us to review long-term debt accounting measurement. Okay, so Barter issued 100. This is 100. I should have a comma here. 1,000 face amount, 10% stated value, semi-annual interest bound at 103. Okay, so this sentence here is the sentence at 103. That means important things. We need to know what it means. That means for each bond, the proceeds of issuing it is 103% of its face amount. So in other words, that face amount is $1,000 each bond. Barter receives $1,030. That's what it is. Each bond is convertible to 100 common shares. After issuance, similar bonds were sold at 97 to yield 11%. So street bond without the conversion feature, this bond will be issued at a discount. So each bond you will receive $970, right? So that this so that 97 means you receive 97% of the face amount. And this is a given, as we said, this is the part that you have to go back to 3351, why it is a given. Okay, so the conversion right had a fair value of 250. This is given to give you options, like, under ASPE, if you have this value, then you have the option is just give this value to the conversion rights and then the residual to the bonds. Record issuance of convertible bonds assuming that Barter follows IFRS. If it follows IFRS, then it has no choice, right? So this part we will receive a cash based on issuing it at 103, so it'll be $103,000, and the part goes to the bonds payable. Is 97, so it's $97,000, and the bonds goes through conversion right. Is the residual increment, $6,000. So this would be what do we have to do when IFRS is applied? Yes. Oh, yes. Okay, what happens after this? So I have here is all bonds were converted on January 1st, 2018. Well, the shares were trading at $15 and the bonds carrying value was 98 414. So I put this 98,414 dollars here, because if I don't put it here, then you have to use effective interest methods to determine it, right? And the original question does not have that. And it's not really the concern of this course. Well, it is the concern of this course, but as far as I'm concerned, I should assume you know how to do it. But this is my thinking. Now, you may not know how to do it, but to assess how you learn in this class, I don't want to, grade you based on what you may not learn from the last class, right? So that's why I put this number here. But since we're learning, so it doesn't hurt if I review it a little bit, and then we can hopefully pick it up. Maybe not, let's just say. So we have enough information. So let's confirm that 98,414 is not pull out from the thin air. So let's do a amortization table, bond amortization table, remember that? And let's do that. Let's do that as a review or for fun, whichever you think it's your sentiment. Okay, so let me remove these. Okay, so we start out at the beginning. It's the date of the issuance of the bond is January 1st, 2016, right? On that date, the carrying value is the issue price, is the fair value, right? Because that like fair value and the cost, fair value and the carrying amount are always the same on the day of the transaction, because you assume everybody is what you call it a rational economic person. So you do not pay more than it's worth, and you do not pay less. No one would accept less than it's worth, right? So on that day, the issue price based on what we are given here is $97,000. Okay, so then it's what did it say? Oh, okay. I think my calculation is based on, let's change this a little bit. I'm sorry about it, just to be consistent. Annual interest, let's scratch that out because the calculation I have is annual. That's annual interest. Yes, the annual interest is paid on January 1st. I don't know where that Sandy came in. They didn't even. So annual interest, interest payment is based on the 10%, the stated value, right? Stated interest. So that on December 31st, 2016, that interest should be 10,000. So 10% of face amount. Interest payment is based on the stated rate, face amount, interest pay period. Now, what is the interest expense? Interest expense is based on the carrying amount and the effective interest rate. So the sentence I give it to you say, after issuance, similar bonds were sold at 97, so that's the market value, market price, to EU 11%. So the interest expense would be 97 times 11%, so it's 10,670. So if the interest expense is 10,670 and the payment is only 10,000, payment is less than the interest you accrue, the difference gets added to the bond's carrying value, right? So that's called the discounting of the amortizing of discount. So the bond carrying amount becomes 97,670. Okay, so this number, if you wish, is calculated as 97,000 times 11%. Okay, so now, first. Now, well, this conversion happened on January 1st, 2018. So that means that that's more than a year later. So we'll have to consider this on December 31st. That's another day we need to recognize. So interest payment doesn't change because none of the terms determine these changes. Yes.
I have a question. So how did you get the 97,670? Did you add the 10,670 to the 97,000?
I added the difference between 10,670 and the 10,000. Okay. Yeah. So because the 10,670 is interest expense you recognize. Remember, you have the debit expense and you have to credit something. And then the 10,000 is only what you paid. So you credit 10,000 you paid, and there's still 670 to credit somewhere, and that somewhere is on the bond. Okay, and this time the interest expense is 10,744, and this amount, see, the interest expense changed because the carrying value changed. This amount is 97,670 times 11%. Okay, 97,670. And so the carrying amount again will be increased by the difference between interest expense and interest payment. So now become 98,414. And that's so this interest will be paid the next day, right? So after this is recorded, like the conversion happened day after, like nothing changed, right? So that's why at the time of conversion, the bonds are carried on Barter's book at an amount value of 98,414. Okay, so having said all that, how do we do it? So conversion of convertible bond is recorded using the book value method. Okay, so that means once the bonds are converted, bond will be gone, conversion rights will be gone. The carrying value of these two will be transferred to the shares they are converted into. The fair value of the bonds, the fair value of the shares, the fair value of the conversion rights, if there are such things, are irrelevant. So that's what it is. Okay, so we remove the bonds payable. Now we do it through two ways. So one is just given as a something provided. One is I show it why it is that, right? And then conversion rights. Which is 6,000. Didn't change since we recognize it. Okay, and all that goes into common shares, which is the sum of these two, so it'll be 104,414. Now, additional information is given here for you to know to ignore. Okay, so the shares were trading at a $15 per share. And so therefore, when you convert these 100 bonds into 10,000 shares, right? And at $15 per share would be $150,000. That's irrelevant. So I will just put it in here to emphasize it. So these are all my work. So I'll make it red so you know differentiate from the question. So note, by the way, note the fair value of the shares issued for the conversion is $15 per share. Each bond can be converted into, was it 100 shares? Yes, 100 shares. And there is a 100 bonds, right? So when you calculated the fair value of the shares issued for the conversion is $150,000. Okay. Which is not used to measure the value of the shares recognized for conversion. Book value, which is the book value of the things that were converted from, right? Book value of the bonds and the conversion rights are the base of the measurement for the conversion. Just want to emphasize that. Okay.
I have
Yes.
a question. What would happen if only half the bonds were converted? Would all the numbers in the entry there be half?
Yes, yes, and the rest will stay on the balance sheet. Assuming that barter follows XP, could barter record this issuance of bonds differently? Yes, it has like a 1, 2, 3 options. And okay, the answer would be yes. There are potentially 3 options. Okay, and not always you can use the first one. The first one would be the same, recorded the same. Well, I don't know if they ask for differently, but I'm just saying all the options. Because the same as under it first. Okay. The second one, assign all the value to the debt. Okay. Recognize no equity. Okay, so the journal, what will be the journal entry for this one? Or we will have to debit the cash 103 And bonds payable, 103. That's it. Now, if you have to record this, like you know, there are 2 years, right, before they were converted, you have to infer a effective interest rate, right? The face amount. So now you will be assuming this bond issued at a premium. And the 11% doesn't apply anymore. And what would be the effective interest rate? That will be the interest rate that discounted all the future cash payment into $103,000, right? The value, whatever value assigned, that value is the present value of future cash payment discounted using whatever the rate, right? So in this case, we do not know the rate that should be used to discount. But what we do know is whatever that rate that we use, when we discount all the future payment, 10% on $100,000 face amount, should give you a present value of 103. So it should be something less than 10%. Because at 10%, your present value is $100,000, should be something less, right? When the discount rate is lower, that means you discount less, so the present value will be higher. That's just and then the third option would be equity first, residual to debt, with residual, assign residual to the debt. Assign the residual to the debt. So measure equity first and assign the residual to the debt. So in this case, we could do that because there's actually a information of the conversion rights. Okay, so in this case, it would be, again, the cash received is the same. The cash is still 103,000. And this time we will do the conversion rights first. And that is $2,500. So what's the residual? 100,500. So it will be that will be the residual. 100,000 and $500. Just going to tidy it up. I don't want it spread out so much. So the 3 options. Okay. So I have if there's a question, I will answer a question, but if not, I will just have a final comment. It's really important. It's like, you know, we know the issuance. I think we got that. It's not that hard for the issuance part, right? For this course purpose, I will not ask you to determine the present value of, you know, of future cash payment, and also I will give you that. And for conversion, even though I will not ask you to determine the carrying amount to amortize the debt and so on and so forth, but you know you need a carrying amount. So when I provide you carrying amount, you got to recognize that's your friend. You know, embrace it. That's the value is given to you to help you a lot, right? Okay, so you know that you will always given the carrying amount one way or the other, and then you know what that is given you for, because that's part of the book value you use to measure the value of the shares issued for conversion. Okay, so that is my final comment on this part. Any question? Okay, if not, yes.
Can I just see the bottom of the question here, just the last?
Oh, yeah, sure. If not, we would just jump to chapter 17 and start with the review. Okay. So oh, actually, before I do that, maybe I will show you like a, I was very happy. Some of you suggest to say, you know, could you kind of make a link to what we talk about this class with the real life, real world example somewhat. So I had a couple of footnotes, like we're talking about the derivatives, we're about hedging, we're talking the stock options. So I have a couple of examples here. So let's see if I could get them. Okay, so that's to share it with. Okay. So this is the Empire Company, you know, like let me about it. This is the footnote for their annual report, and then I think it's 2018. Yeah, to be. So in the footnote, they have some hedges, and this is their disclosure. The company's cash flow hedge consists principally of foreign currency swap, electricity sales agreement, and a natural gas sales agreement. So just look at these, unpack these. So foreign currency swap. So that means there must be some transaction either requires them to pay in foreign currency, or they will earn foreign currency, right? And when the foreign currency translates into Canadian dollars, if the foreign currency exchange rate changes, that could translate into different amount of Canadian dollars. And so by entering these swaps, they will ensure these transactions that's going to happen will, the amount realized, the amount you paid will not vary in Canadian dollars. Okay, so that uncertainty can be minimized or mitigated altogether, right? So, and this is what would be cash flow hedge, is this will be the cash you have to pay in the future, or cash you will earn in the future, right? So you want to make sure that when those money you have to pay, or those money you're going to earn, that when they translate to Canadian dollar, they're not going to change. So that's what it is. And so electricity sales agreement, natural gas sales agreement, knowing the business they're in, I suspect that they're buying electricity, they're buying natural gas for their own consumption. But that will, if the exchange rate changes, that will affect their operating expenses, right? Like for something that's related to foreign currencies. Foreign exchange contracts are used to hedge future purchases or expenditures of foreign currency denominated goods or services. Electricity and natural gas sales agreements are used to mitigate the risk of changes in market price of electricity and natural gas. So they have foreign currency exchange rate and the swap commodity related to commodity price. Gains and the losses are initially recognized directly into other comprehensive income because these are cash flow changes or loss, and are transferred to net earnings or loss when the forecasted cash flow affect net income or expense for that year. So when the actual purchase is made, these gain or loss will transfer out of the other comprehensive income set recycled amount, right? As of May 5th, 2018, that's their fiscal year end, the fair value of outstanding derivatives designated as cash flow hedge of forecast transactions were asset of 0. I think it's just less than $1 million. In 2017, it's $1.1 million asset, and the liabilities of 0.2, and now the 0.9 year before, right? So that's just a glimpse of what do we do, how that will actually being used in real life. That's one. So not sure here. Let's go back to, I think I have one more. Okay. One more is yes, this is the one that's, in order to share it, I need to download it. So I'll share the second note, also from the same company, but this one is stock option. Okay, so there's a stock option. I hope you can see it online. So they have stock option plan. And so these are all the information you need to review. During the year, the company granted over 1 million options under stock option plan for employees of the company, whereby options are granted to purchase non-voting Class A shares. Also, these options allow employees to purchase shares. The weighted average fair value of the option is $3.62. That it will be used to compute the total compensation expense, right? So fair value. So here using the that was determined using the Black-Scholes model with the following weighted average assumptions. The share price, that's a Black-Scholes model. We don't have to worry about that. And the compensation expense for the year related to the issuance of options were $2.6 million. The total increase in contributed surplus related to stock options is $2.6 million. Of course, that's a journal entry, debit compensation expense, credit stock option. And so these are the information. Let's just look at this one table first. So these were outstanding from the beginning of the year. They were either not, they were not exercised, they were not, some of them are not vested yet. That is the total options granted at the beginning of the year. During the year, additional 1.3 million options were granted, and 123,000 were exercised during the year, and there was 750 options were expired, and then there were 730,000 forfeited. The difference between expired and forfeited is expired means that they were vested already, but for one reason or the other, they were not used. Okay, and the forfeited is they were granted, but before they were vested, something happened so that grantees were no longer entitled to use these, and so they were just canceled. Okay, so at the end, the total options outstanding is about almost 4.7 million, and right now there are half of that were exercisable. Means if they're there are lots of considerations. It's a whole other story. One of why they exercise, but the minimum they should be in the money, right, to exercise. So that's a option. And you can see these are the footnote disclosure information and how that will affect your financial statement a little bit, affect your expense. An income statement, and you have to show this equity on the balance sheet. Okay, so that's just a quick side detour to see that what we're talking here is real, right? Okay, so we have little time left. I think it's just enough to do our quick review. I will download this. Okay. Okay, so the net chapter 17 is about the earning per share. And so let's start with this example here. Okay, this is the Canadian Tire's income statement. Okay, we know what the bottom line is, but when you look at income statement, you go straight to the bottom, you don't see the bottom line, right? The bottom line should be this net income. Right? When we say bottom line, we mean net income. So for year 2020, which ended January 2nd, 2021, Canadian Tire earned $162.6 million. That's their profit. And following that, we have a little bit of you have non-controlling interest, and then you have to separate that. The part goes to the Canadian Tire shareholders, the part goes to the non-controlling interest. We know what that is, right? That's the subsidiaries that's not 100% owned, but they were consolidated. So the subsidiaries' assets liability will be 100% included in Canadian Tire's consolidated balance sheet, and revenue expense will be 100% in the income statement. However, Canadian Tire is not entitled to 100% revenue expense. And so in this net income would include the income that is not Canadian Tire's net income, okay? The part of that belongs to the non-controlling interest. And in here, all the non-controlling interest together has a claim of 110% of total net income reported here in this number. But below that, we have two. We have basic earnings per share and the diluted earnings per share. So the basic earnings per share is $12.35 per share. So this is of interest to shareholders. So if you own say 100 shares, you know what's your share of the earnings. And the diluted earnings per share is $12.31. So diluted earnings per share, just the word diluted implies it should always be less, or could be same as basic earnings per share, but it should not be more than basic earnings per share. It's diluted, so it should be less, or at least not more than the basic earnings per share. Okay, so to talk about this, so that let me have a quick review on the financing structure. What do we mean by that? So the financing structure of a company To talk about that, we first look at the basic accounting equation or the fundamental accounting equation. That is our balance sheet equation, right? So we have assets, and that should equal to liabilities plus shareholders' equity. And that is actually your, on the left-hand side, assets are all the resources available under control that the company can use to generate revenues, to earn a profit. So it's all the resources. And so on the right-hand side are the sources of the resources, So these are all the financing. Okay, we commonly say, well, you have debt financing or have equity financing. That's true. Debt financing or equity financing. But for the sake of our computation of determination of earning per share, we need to go a little bit more in detail, right? So for liabilities, if you look at close date, there are two different kinds. You have operating liability, and then you have financing liability. And then for shareholders' equities, you also have preferred shares, and you can have more than one class of preferred shares, and you have common shares. All these four are basically sources for your resource, or all these four categories together finance the acquisition of all your assets. Okay, so that's essentially what the situation is. So all these together collectively contributed to your being in possession of these resources. And therefore, all four sources also have a claim against these resources. Not only all four sources will have a claim against the resources, they also have a claim of the earnings generated from using these resources. Okay, so claims against earnings, earnings generated from using the resources. As I said, they have a claim of the what's on the balance sheet, but they also have a claim on what's on the balance sheet that when it's used, that earned, that generated, right? So operating liabilities that they will be like provided by suppliers, provided in terms of accounts payable, provided by your employees in terms of wages, salary payable, provided by the government in terms of tax payable. All these are incurred, you accrued, but you have not paid yet. It's provided, it's sort of financing, but it's a free financing. Walmart is very famous in terms of taking advantage of these free financing because it's such a big buyer. So for lots of its suppliers, he's the only customer. So they often negotiate a term that they can wait for a month, 3-4 months, maybe even longer before they have to pay for their purchases. But why do they insist on that? Because that's a free financing, right? So that those usually is free For the financial financing liability, so these will be the financing provided by financial institute in terms of debt or your bondholders. And they do this to earn an interest. So their claim on the earnings will be interest. Although this will be the after-tax interest, okay, because interest is tax deductible, so the net would be after-tax interest from company's perspective. Preferred shares will have a preferred dividend, and the common shares claim is the residual. What's left? Okay, so when we compute earning per shares, we are doing this from the common shareholders perspective. Okay, so when we see that earning per share, it's earnings per common share. They are the true owners of the company. And when we do analysis, when we do reporting, that's where the focus is. Okay, so now one more thing before I go. So how are they reported? Okay, so these two together is the net income, right? The interest is expense. Interest expense. Now, most of the times these lines are clear. That's when company has a simple capital structure. The diluted earning per share comes to play because some of these financing, they can potentially become common shares. So such as convertible debt, convertible preferred shares, there's a possibility those financing can be part of the residual interest. And that's when there is a potential shares exist, then we say there is a complex financing structure, and then we need to the diluted earning per share says if those potential shares become real shares, how the earning per shares will be affected. Okay, the worst possible scenario. So that will be over today, or 1 over 3 minutes. I think the assignment is due this weekend, so just a reminder. Other than that, or next week.
So how would you, for the assignment on the Excel or Word? Or
It doesn't matter. So you can even combine, the only requirement is that should be a submission of one document.
Got
So if you use different programs to do your homework, make sure you combine. Actually, the best way is to capture the screen and put it in one so that doesn't
So
change your format.
if I did it by hand and submit it, so
I will accept it, but given you're going to be accountant, you better to be comfortable with these things, okay? So the one warning is if you use Excel, if you copy, paste it to Word, the format usually change, so make it very difficult to read. But if you capture it as a screen or like post it as a picture, paste it as a picture, you don't lose your format,
okay.
okay?
So I can do it in Word document.
Yes, you definitely can.
Are we in the other class next week?
Yes, we're back to normal classroom next week. This is just a convocation.
I have a question about that.
That is,